Fund is the country's largest asset manager with over 66 billion under management. We will be hearing about the different alpha generating ways the super fund employ, such as its active equities and tilting programs. We'll also be talking through the role different asset classes play in the New Zealand super fund's portfolio, such as shares, infrastructure, commodity and other alternatives. Finally, we'll be talking about the broader economic landscape and the risks and opportunities for New Zealand-based investors. This is a great opportunity to learn about the NZ Super Fund and the broader outlook from one of the world's most recognised sovereign wealth funds. Mike, it's awesome to have you here. Thank you for joining us. Let's start off by the role of the super fund and its place in society in New Zealand and how you think about that in your role.
Thanks for having us, Stefan. I must say, I just for those people out there, I see Stefan fairly regularly down in the changing rooms. He's often come back from a rapid 10K and at breakneck speed, so it's good to talk on other matters of how broken down we both are. But look, the Super Fund, we just about to have our 20-year birthday. We were established in 2003 by the Michael Cullen and the Alan Clark government as a solution to a long-standing problem of what do we do with an ageing society with a super system that was a general entitlement and paid for out of current tax state. And this was actually was a big problem or a big issue that sat around for a long time. And in previous life, I actually worked in closer to government, looking at the superannuation issue. So this was going back to the early 90s, where we started thinking about what do we do with the ageing demographics and how do we continue to fund and provide New Zealand superannuation. And so Michael Cullen in 2003 came up with the idea of putting some money aside, contributing to a fund that could take a very long-term perspective, had a sole purpose, which was to invest and then from those returns over time start contributing back to the government money that could basically look after and continue to pay New Zealand superannuation. So 2003, 20 years old. And I think the most important thing is, I guess, we've gone through some really interesting periods, those really early periods where we were sort of trying to work our way into our teen periods, where I think we've sort of landed on an investment approach that works for us, and now getting into our, I guess, more let's say adult years, mature years. Obviously, we actually modelled to be around for a long time, long past when I've fallen off my motor coil, and continue to provide and contribute to superannuation and other government objectives.
Fantastic. So you on your website you talk about a number of endowments that the fund has, and one of those endowments is a long time horizon.
Yep.
What does that mean for you as an organisation, and what does that mean, or can you juxtapose how that changes how you invest compared with, say, a traditional investment manager?
Yeah, sure. So yes, we identify sort of 4 endowments. What do we mean by an endowment? This is something that, I guess, because of our nature, our structure, the fact that we're set up in legislation, that we're a government entity, that we think gives us maybe a little bit of advantage, or at least it allows us to work out where we should be focusing our attention. So our 4 endowments, it's that we have a long-term horizon. What does a long-term horizon mean? As modelled, we are modelled by the Treasury, and anyone who wants to really dig down into that model can go on the Treasury website and see it. But as it currently stands, we'll continue to invest and not really start feeding back to the government until the mid-2030s. And even that's quite a small return back to the government. We don't really hit significant re-contribution back to the government until sort of the 2050s. That's a long time to think about not having to pay liabilities or not having liabilities to fund back. As a result, that allows quite a degree of latitude in terms of what we can do. What it means is we can invest in illiquid assets. What it means is that we can also ride through the short-term volatility where we feel comfortable doing that. And we understand that because of what that means is we can take a slightly higher risk portfolio. What it means is that we'll probably face a fair bit of up and down, but we won't be stopped out when returns are quite low, or we expect to have periods of low returns. But that long-term horizon means we can ride those things out. And that means we can really focus on investments that will have a long-term payoff.
I think it's fair to say that makes you, in investment markets, relatively unusual, because ultimately most investors are acting as an agent for somebody else, be it retail mums and dads or some other client, whereas in many ways you're acting as principal of your money being part of the government.
I'll be very careful because it's not our money. It's New Zealanders' money. But we have, we set up in legislation, which means the legislation also directs us in terms of what we can do. So the legislation is very clear. We believe it says maximise returns, subject to basically avoiding undue or without undue risk to the portfolios of funds. So we're not out there putting it all on black up at Sky City. We are taking, sound, well-considered and making sound, well-considered investments, but that long-term horizon just means we don't have to, we still report our returns regularly, but we also, again, set an expectation that because of what we do and how we do it, there'll be ups and downs. And it's an interesting story. I recall when we went through that first COVID period where markets sold off and, the fund was down quite significantly, like most funds were. But we'd actually done a fair bit of communication in the previous years saying, look, if we go through another GFC, we could lose 30% of the fund. But that's what we face, and that's how we think about things. So when we went through that COVID period and we were down at quite a few $1 billion, the market commentary and the media commentary was like, oh, so this is your time to invest, not we'll take your foot off the accelerator and things. So I think, kudos to our comms team making that people aware, or at least decision makers aware that that long horizon is relevant to our investment choice and therefore our returns.
Just on that, I actually had it as a later question, but the perfect spot. You have on your website a paragraph which I just want to read out because it was, for me, it was quite punchy. So it says, you have a section saying, holding the course. The expected recovery in the fund's value is only feasible if we are able to hold the course with our investment strategies through a market cycle. So the major risk to the fund is not that we will experience significant volatility in its returns. We know that will happen. The major risk to the fund is that we lose our nerve, close down our investment positions, and lock in the losses experienced in a crisis. This would significantly impair the ability of the fund to fulfill its long-term purpose. And I mean, it's quite intriguing, right? Because you're so express about that, and then maybe it's a maturing of the commentators that would otherwise say, "Hey, you've just had a bit of there's some red there, but actually, no, now's the time to reinvest, and now's the time to benefit from the volatility."
And I think it's a really important point, and we try to express that. We're very humble, but we do have some. I guess we've got some runs on the board. We're humble, so I'll be careful blowing our own trumpet, but we've been successful. It's been a period that has been beneficial to high growth, high equity funds in the last 10, 15 years even. But we've got some runs on the board there, so that I guess gives us a little bit of wriggle room as well when we have those negative periods.
So the other endowments, in addition to long-term horizon, you've got operational independence. What do you mean by that?
Yeah, that just means that, we're a commercial, we operate commercially. Yes, we're government, we're a Crown financial institution, but it's very clear in our legislation that we're there to maximise returns, and so when we look at investments, they're on commercial reasons.
The other one is sovereign status, which you mentioned just before, but what does that mean as an investor? It gives you an edge or an advantage?
Yeah, there's a couple of areas where that does give us benefits. Sometimes in some countries it gives us a tax status. It gives us some tax advantages in those countries, being a government fund. And also we find we do a lot of investing with partners. We're not experts in some things, so we end up looking for partners to invest with. And being a government based fund, they know we are here for the long term, that we're a pretty safe nation, and therefore there are plenty of other funds out there who want to partner with us in investments. And there's many other sovereign wealth funds who we talk to all the time. We visit all the time. We share information, we share ways of doing things, and so naturally, where investors can share risk or bring in different expertise or different sources of capital, they come looking to us.
So that means you partner with other sovereign wealth funds?
And other funds in general. We've got quite a few things on our portfolio. We've got other partners, including some of our really big investments in timber, and also some of our more recent investments in healthcare as well.
Okay. And the last one you say is governance. Why is that considered an endowment?
Yeah, that's one that we've sort of been working on for a few years, and we've introduced just in the recent years. And I guess it's a little bit connected to the operational independence in that we're at arm's length. We're set up in legislation. We have an independent board. So there's that part of it. There's also, I think, the way we operate internally. We're continually evolving internally in terms of how we do things. We have quite a strong delegation framework. So while our board sets the risk appetite of the fund, they delegate a lot of the decision making to management, and internally management delegates downwards and within. So that what that means is that it allows us to move reasonably quickly. You always, when you're investing big swaths of money, you're not going too quickly, but it does allow us to be nimble.
Often investment opportunities require you to be able to respond as the time comes up.
Yeah.
So, okay. Take us through how you think about deploying the capital. So when you visit your website, for example, you talk. There's quite a lot of emphasis on your tilting program.
Yep.
Portfolio completion.
Yep.
And active areas of active management.
Yep.
And then there's a little bit about liquidity. Which of those are the ones that you feel you really drive value for New Zealanders, and why is that? Markets are efficient. How are you able to extract? Well, so they say. How are you able to extract alpha for the betterment of, your purpose?
Yeah, well, if I take a backwards step quickly, a lot of this is on our website, so anyone who wants to dig deeper, feel free to hit the website. But when we build our portfolio, we start with what we call our reference portfolio, and that's essentially, if you think about it, it's a simple market-based portfolio that sets a basic asset allocation, equities and bonds. And by setting that, we do that every 5 years. We review that reference portfolio. The board makes the decision on the allocation, and that sets the fundamental risk appetite of the fund, and it basically sets our expected return path for the fund. What we then do is management then goes away and is given some active risk to invest across a raft of portfolios. What we do is we effectively sell down the assets within the reference portfolio to fund the our active portfolio and our active investments. And what that does, we risk match the sell to the buy so that the risk in the total portfolio stays fairly constant. But what it means is we are looking for investments that improve the Sharpe ratio and then improve or provide us with active return, which we call it active return rather than alpha, but I guess it's the same thing. And then we look at a whole raft of potential opportunities where we think we can find that active return or increase that Sharpe ratio. And I guess we've got around 20 odd opportunities, what we call opportunities. They're sort of sub-asset classes, the traditional ones like real estate, like infrastructure, our rural portfolio, our timber portfolio. We've got some global macro in there. We've got some sort of hedge fund strategies. Commodities. Well, we think about timber and rural as in that space. But we have a few insurance products in there. And some PE, venture capital. Quite a broad raft of different investment opportunities. And I guess a couple others in there you refer to was the strategic tilting and also our tactical credit mandates. They're internally run mandates. Many of our mandates are outsourced to managers. But the strategic tilting, that's one where, we look to understand or look to invest in markets that we think are cheap or expensive. So that makes sense, really. You buy low, sell high. But we run that program by looking at markets where we think there are some mean reversion tendencies that we think we can understand the basic economic fundamentals that drive returns in those markets. But it's across equities and FX, bonds, bit of commodities in there, real estate, credit, and across multiple geographies. And what we find there is, because of our endowments of being able to be long-term horizon, being able to go through periods where markets move away from our expectations of true value, we can hold positions until the market comes back to us and adjust our positions accordingly and hopefully turn some alpha. And again, that strategy, all of our opportunity strategy or our opportunity framework's been in place for about 10 years, 15 years, have been reasonably successful. Tilting has been exceptionally successful. I was just looking at the numbers recently. Since inception 20 years ago, our portfolio has delivered 9.5% average return. Our benchmark, now this is another critical part of the reference portfolio, that's our benchmark, because that's what we would invest in if no one worked there. Our benchmark's return about 7.9%, so our active return of about 1.5%, that's what management has delivered. So we're comfortable with that. I think if you compare our other little benchmark that we keep in mind is, of course, the government's cost of funding, because ultimately we're on their balance sheet. We look at that in terms of T-bills plus a spread. I think the spread currently is about 280 basis points. So we're about 3.5% per year above that spread. So, that's hopefully the government's happy that we've given them half decent return.
1.5% and 3.5% to listeners might not sound on the face like a lot, but when you're multiplying it across billions and billions of assets,
well, here's another
and annually and compounding it through time.
Here's another way of thinking about it. So since inception, the government's put about $25 billion into us. We pay tax to the government. We've paid about $9.5 billion of tax. So from that net sort of $14 or $15 billion input, we're a $65 billion fund.
So put in perspective, it's about 20% of GDP, right?
You've got good maths. Yeah, it's about 350.
Yeah.
Something
Give or take.
Yeah, and as I say, we're expected to continue growing. We will continue growing actually forever. As a percentage of GDP, I think we peak in the 70s or 80s of the century. We, as I say, model to start returning money to funds to government for super in the mid-2030s. But we're actually modelled to start being a net contributor to the government with our tax, sort of from the mid-20s, from another 2 or 3 years from now.
Just back to the reference portfolio, you've got a lot of assets there that range from price daily to timber, which is a 20-year growing cycle or more. How do you guys manage that? You talk about sharp ratios and things like that. Manage the variety of horizons there.
So again, it all comes back to thinking about risk and return, what we think the expected risk and what we think the expected volatility is of the assets that we're purchasing, so that we can match the expected volatility of the asset we're buying with the expected volatility of the asset we're selling. And we think about those volatility through the cycle volatility concepts. So we think, you talk about timber being a sort of marked probably annually, maybe a guess about what it might be. But because you're looking at a sort of longer term volatility of that asset, it's not such an issue. I mean, we continually think about different ways of understanding the risk that we're taking on in the portfolio. We also have to match or have to think about the volatility of return for the likes of those illiquid assets with our liquidity appetite. We do have a fair bit of the portfolio in illiquid assets. We do have liquid or liquidity obligations when markets are moving around. We do have a fairly sizable derivative portfolio, both through the way we execute the portfolio, but also because we hedge 100% of our external assets. As a result, when markets are moving against us, money is flowing out. And of course, when you've got a forest, it's a $2 billion forest, you can't really
Chop a small
part of that out in a short space of time.
You mentioned reversion to the mean, but obviously diversification is very, very important in how you think about investing, and it's something we talk about a lot internally. How do you go about adding a new opportunity and assessing existing opportunities to say, hey, this is where we want to be, or not where we want to be?
Yeah, say we've got about 20 odd opportunities. Some of them are sub, so real estate, for example, has 2 or 3 opportunities, infrastructure has 2 or 3 opportunities. It's quite an in-depth process when we identify new opportunities. It's a process that our senior investment strategists go through, identify something, making sure we have confidence that we understand the fundamental drivers of the returns, that the returns are going to be constant, that the returns are going to be connected to those drivers, that we are able to use our endowments to access those excess returns. It then goes through an internal analysis process. It goes up through our investment committee. And then at that point, we start, once we've got to the point of saying, we think this is an opportunity that we can access, and that's an opportunity we understand the drivers of. We understand what the risk is, so we know, again, what we're selling, have to sell against that new opportunity. We think we can understand the excess return. It's then, okay, how much do we want to allocate to that? And often it comes back to what we think the information ratio will be for that asset and how we think that will improve the performance of the fund. So it's quite a lengthy process, and the determination, I guess, of how much we put into that opportunity can take quite a bit of time. There have been times, I guess, when we've looked at opportunities and maybe by the time we've sorted it out, maybe some of that the expected return is gone. Maybe that means it was probably one we didn't need to be part of in the first place.
Yes, it comes back to your long time horizon. Then if it takes 6 months to get through the process and you've got a 40-year horizon or something, it's maybe you don't need to be there.
Yeah, sorry, just jumping there, Stephen. So the other thing is we will identify an opportunity like real estate, core real estate, and then we'll allocate an amount of risk to that opportunity, and then we give it to our access point teams, and they're the ones who go out and actually find the deals. And if I think about something like a real estate opportunity, real estate, it's quite broad. Right from retail strips to office space to logistics, and clearly when you're within that space, we can talk about the environment in a moment, but different parts of that opportunity are moving at different speeds and providing different periods of attractiveness. And so it really sets an interesting bottom-up versus top-down discussion about how much we should be allocating to real estate That's the top down versus the bottom up. Investors go, wow, look what I've got over here. It's really attractive. We should be doing a whole lot. And that's what we call it's a component we call the total portfolio approach, where we're continually having a bottom up versus top down. There's continually competition for capital across the portfolio. So it's not quite like the traditional SAA where you go 5% there, 10% there, and 20% there, and you go and do it. No, it's much more. We'll move our money across the portfolio where we're getting the best bang for buck. So that we think is a modern way of allocating funds and a modern way of getting best performance and returns.
So, given that sort of framework, it must mean your role as chief economist is very different from forecast where the OCR is going over the next couple of months, or reporting on the latest PMI number or something like that.
I mean, I guess we'll still do that, but you're right. Effectively, like I haven't been an economist in my life, but I've been in the forecasting game in a previous life, and it's a mixed game. You certainly don't. When you're investing, you're taking long-term views. It's a tough game to be making investment decisions on where you think inflation is going to be or where you think the market's going to go. So we spend more of our time looking at the portfolio from the top down, how it's sitting, how it's evolving through time within the environment that we look in. We do understand and we do look at what are the macro drivers of the different part of the portfolio. We also do a bit of scenario work that says, hey, if the world evolves like this, then the portfolio might go like this. But and I've talked to a lot of peers around scenario building. It's not necessarily or not usually an allocation tool. It's more or less a conversation tool that says, how comfortable do we feel in this environment with what we've got?
Okay. ESG and its role, and it's something that, again, you guys have been very vocal about. I suspect it plays into your governance endowment too. You talk a lot about climate change on your website, and that's driving some of your investment decisions, and also how you talk about your role as a sovereign wealth fund and the role of investments more generally. And then there's also demographic shifts in there. What, day to day, what do these bigger trends mean for you as an economist, making and advising on decisions internally, and then from the bottom up mindset, what does that mean for how, I guess, your opportunities get executed?
Talk about ESG. So, when you're a long-term fund, the thing that, you're not making necessarily decisions daily or monthly or whatever, you're making long-term investments. The things that kill you are getting the trends wrong and making wrong decisions around structural change or when things are moving in certain directions that you don't see. We've been looking at climate change for quite a few years now and making adjustments to the portfolio around carbon emissions. And I think this started probably started looking at it in the mid-teens and then started making portfolio changes at the end of the 20-teens. And our first part was looking at the carbon emissions within our reference portfolio. I guess you take a view that there's a point where the market will adjust equities that are exposed to carbon, and whenever that point will be, we don't know, but maybe we think the market is not pricing it quite right or pricing that risk quite right. We can take a long-term position, we can make that change now. And so that's what we did. We made changes to the reference portfolio part of our portfolio to reduce carbon emissions or emissions intensity, as well as potential carbon emissions from fossil fuel reserves. And what we've, as I say, that was sort of 5-6 years ago, we've cut our exposure in our reference portfolio to emissions intensity by about 50%, 60%. We've cut exposure to fossil fuel reserves by about near enough to 100%, doesn't matter. And it really hasn't had an impact on performance. Ups and downs when oil prices go up, but we don't look at that. What we do is we go, no, this is our long-term position. Actually, more recently, we've made a slight adjustment again to our benchmark equities by adopting the Paris-aligned benchmarks. Again, we think this fits into our sustainable investment framework. We think we're buying or holding assets that have got that sustainable characteristic, which will be better for long-term returns. It might be miss out here and there on ups and downs, but we think for long-term, much better. So that's been a really strong focus for us. We've also got a few assets in our portfolio that look to the long term, and climate change particularly. We've got some alternative energy assets that have performed incredibly well that we've invested in with one of our infrastructure partners, infrastructure managers, and you might be aware we're also started looking at offshore wind down in the Taranaki Bight. So, these are long-term projects. We've had some success, but we think this is the path, particularly in that ESG space.
How do other sovereign wealth funds globally, apply ESG? Is it in the same way, or is it
a fairly big range?
Yeah, I would have thought if you're in a Saudi sovereign wealth fund, you might look at oil differently, for example.
Yeah, so it's always an interesting one. It's fair to say the Europeans are very strong in the ESG space, and we spend a lot of time talking to our Scandinavian partners or peers about what they're doing. Look, if you think about what are global tailwinds for investing, we like to talk about tailwinds in investing because you don't necessarily need to be right, but if you've got the wind behind you, you'll be going at pace. ESG investing has a massive tailwind. We know that investors are looking for things, or they're mandated to find things. Some of our European peers, their mandates are around you must have, or you must consider. We are not in that space. We are a commercial. We remain a commercial. We look to returns, but we're cognizant of the wheels that are moving.
Drives a lot of behaviour. I imagine it also means if you're early in the investing phase, and you're expecting that tailwind to continue, it'll put pressure on prices as more people demand those assets.
Yeah, that makes sense, and it's not just tailwinds, but it's also risk. There's clearly regulatory risk in that space. There's clearly insurance risk in that space. There's probably catastrophe risk in that space as the world evolves and changes, both what the world does to us and what we do to it, and what, as I say, regulation changes we make. So, those are risks that we are not 100% sure the market is able to price, because the market has not necessarily got that
time frame,
10, 20-year horizon. If I'm looking at what my next year performance report's going to look like, I might not be thinking about that.
I think, we've spoken about it a lot. I think you think about the way in which our market prices, it's building probabilities for different outcomes. And if that outcome is a long way away, the probability that the market attributes to it can be quite different.
Yeah, and even getting more geeky about talking about discount, DCF models. And most of our DCF models are pretty simplistic. Some expected return, and we know there's going to be shocks in the future, but they're not in our models. And so if we keep pushing that shock or concern out further, it's discounted away to not very much, and so it becomes too hard. We can sort of say we don't know when it's going to happen, but we think it's going to happen.
Yeah. You mentioned liquidity earlier, and New Zealand market generally it isn't the most liquid in the world, it's fair to say, and yet you also have a New Zealand active equities opportunity. How do you manage around that, and what and how do you support the New Zealand capital markets, but with the fund, at 66 billion, there's only so much you should do.
Yeah, we've got about so in our reference portfolio, we have a 5% allocation to New Zealand equities. So we start with fairly decent. There's 5% out of 100, of which 80 out of the 100 is equities. 5 of the 100 is NZ equities. If you were talking about it on global market cap basis, it'll probably be
Well, we're less than 0.5%.
yeah, pretty small, right? So we do have an over allocation straight away to New Zealand equities. So it's about $2 billion in our portfolio, both run internally, and we also have a couple of managers who look after money for us. When we think about liquidity, we define liquid assets in our portfolio in a certain way. It's basically anything that we can turn into cash in 10 days. And then we make some conservative assumptions around those things that we can't turn into cash within 10 days. And one of those conservative assumptions is maybe not New Zealand equities. And that's not saying the market's, that's not making a comment on the liquidity of the market. It's just saying, here's a conservative assumption. And then we sort of work out, well, when markets move at their worst, this is how much money flows out of the fund, and how much of a movement in markets can we survive? And we do a bunch of reverse stress testing to actually understand how big a market move before we've run out of liquid assets. And that's without making any managerial changes to how we do things. But we've got what we've got. We're a New Zealand fund. We think and we invest in New Zealand for a very strong reason, that we think we understand New Zealand. We think we understand, what drives New Zealand, where it's going. We think we've got connections. We think we can make positive investments, and we do. We have put myself on the spot without having the numbers in front of me, but it's quite a big chunky portfolio across timber, rural, private equity, active equities, and we're very comfortable in this space.
Fantastic. How do you bring, because you must be getting so much information from lots of different pockets around the business and around the economy in New Zealand, and from all your current investments, and then from your partners abroad. How do you bring it all together to be able to give you the information edge or advantage as an organisation that you could have, or you do have? There's a sort of practical overlay here, wherever there's little pockets doing different opportunities, I'm guessing, and then how does it come together? Is that the investment committee? Or
I guess it's the investment committee pulled together. The investment committee is made up of our heads of and GMs who are involved in investing in the different parts. We've got our asset allocation area, top down. We've got our access point teams that bottom up, and we analyse the portfolio from top down. We analyse the portfolio from bottom up. We have regular reviews of the reference portfolio. Obviously, we have regular reviews of how we allocate our active risk across our different opportunities. And I guess it's a continual, understanding, monitoring, thinking about how we can best get the best out of the portfolio. We are not afraid of saying, actually, that didn't work. So let's terminate that one, and we learn from that. And then when we identify things that are going well, we push more into them. So it's right through the fund. We spend a lot of time just because we're a long-term investor. Things are not happening every day. We're continually looking at what could we be doing, or what could we be doing better, or how might we be evolving things. So that's certainly, if you think about from 2003 or even from 2010 when we implemented our reference portfolio, it hasn't been a set and forget by all means. It's continually top down, bottom up. Different people come into the organisation. We embrace different ways of thinking about things, different ways of doing things.
Yeah. Maybe to change tack a little.
Sure.
You talked about sort of big structural tailwinds, things like that. Interest rates and inflation.
Yep.
Yeah, we've had interest rates basically falling until the last couple of years throughout our careers. How do you think about that, and where that path may change your investment profile going forward?
Yeah. So I'm an ex-central banker, so I've spent quite a long time at the Reserve Bank of New Zealand. So part of my DNA is thinking about how economies work and how interest rates work and so on. And the thing about economists, we spend a lot of time trying to understand how the world's evolving and what's the drivers, and typically when we think we've got it right, it changes. And I guess, we spent, I guess from the 2010s coming out of the GFC, we had quite strong changes coming out of the GFC. We had, China becoming a major player on the market. We had a lot of cheaper labour coming in both from China, Eastern Europe, Asia, which basically gave us this massive disinflationary tailwind that was a real supply side, a real struggle. Central banks spending a lot of time trying to motivate inflation.
That's a good term.
Yeah, and because central banks largely demand side manager, and then of course we had COVID, and I guarantee if we'd been sitting here more than that, 4 years ago, 4 or 5 years ago, we'd be having a completely different conversation. We'd be having a normal conversation. Interest rates going to stay low forever. What are you going to do about it? Well, going to be all over equities. But we went through a 1 in 100 year pandemic, and I don't think too many people experienced the last one in Spain or the Spanish flu. We went through basically government shut down the global economy for a period. We had then one of the world's largest ever policy responses, both fiscal and monetary. Then we threw a war over the top of that. So we've gone through a period of wow, and none of us, I went through GFC and thinking, well, I hope I don't have to go through that again, but this has been a little different, but I hope I don't have to go through this again. But and we're still coming out the back of that. So when I hear conversations around, interest rates back to where they were, real rates, long-term rates, that we were down at 0 or 0 barely, and now we're back at 1.5, 2. I'm a little nervous to make that immediate jump. There are definitely drivers there for higher real interest rates, I think, going forward. Internally, we've made some assumptions around, we were revising down our real rate assumptions, and we've finally just ticked them back the other way. And I think many of our peers are doing the same thing. I don't think we jump in boots and all into, no, we're back to where we were 20, 30 years ago. But I think the direction is that way. Inflation, again, it's one number with multiple drivers, supply and demand. I look at sort of what has been going on, and again in China. China's probably going to maybe save the world again by exporting its deflation. But I think central banks, they've done their job. They've done what they can do, and we just got to now ride out that disinflation period as inflation comes back to somewhere more comfortable.
And the yield curve tells us a lot about the future of, I guess, interest rates and inflation and the way assets are priced. What are you making of the current shape of it?
Well, I guess if this is one place, about to contradict myself, but if there's one place where we can say some of those old term drivers are coming back, it's in that yield curve, it's in that term premium. Whether you believe the modelling or not, but you look at some of the US federal modelling of their term premium, negative 80, 90 basis points through the 2010s, just thinking there's no return for holding long bonds, holding duration. And you're now seeing that return, obviously. That's been a big driver of the most recent bond movements, has that been that term premium. When you're an investor like us, we like duration. We long term, so we like getting paid for duration. So that's good for us. We think that's a good direction for us. What are the drivers? Are they new drivers? Are they old drivers? Are they return of the old drivers, or just a transitory blip until we get back to flat to zero? I think I'll be the economist, a bit of both. That you'll have there are drivers there. I'm mindful of fiscal positioning. I'm mindful of what central banks, particularly the Fed, are doing around their quantitative programs. They've switched from 10 years of quantitative easing to a start of quantitative tightening. They can do that at the moment because they haven't had an economic downturn or recession from their tightening period so they can continue that quantitative tightening.
And the US is surprisingly resilient.
I feel like I've been talking about, inflation and rates and central banks for about 2 years now. And the bottom line is all us economists have been going, can central banks engineer a soft landing? That's really hard, because you're effective. It's like steering a longboat, but a 2-year longboat, where you've got to turn now for your corner, 2 years and 18 months that you can't see. And you've got to stop before you hit your target. Otherwise, you'll go through it and cause problems. And so, central banks look like they've peaked, although the market's been saying that for about 18 months. They look like they've peaked. They look like they feel they've done the job. And, US seems to be the one that has been able, that economic activity has been able to maintain it. I mean, I can point to a whole lot of historical charts that show no recession is on the cusp. Everywhere. But no, that savings built up over that COVID period is just holding out. And touch wood, because no one wants to see economic recessions. It's bad for investors. They may have managed it, but we'll see.
Very good. New Zealand and the US seem to be surprisingly correlated in how our economies deliver. Do you see that continuing? Why is that? And do you see that continuing?
Yeah, that's.
And it seemed to have been that sort of canary in the coal mine for the US in some respects.
Well, I think policy, monetary policy, we moved early. We're one of the first movers. We went hard through the COVID period, the period of uncertainty. What do we do? Well, let's just go hard and do whatever we can to hold things up. And then when we came out the other side, it became clear there was inflation pressure. We moved very early and moved hard. And I guess, every Henry hindsight can be a critic, but we did lead the field there, and others followed, did the same, but just behind us. And so I guess that drives that correlation. Of course, it will depend, I guess, on what happens next. Obviously, both economies are still reasonably strong labour markets. The labour market's typically the last thing to turn through a tightening phase, but remaining resilient there. I guess the US being more or less a closed economy, that has a different effect than New Zealand, which is clearly an open economy and gets buffeted around by some of the global winds. The US seems to be able to pull down, or inflation in the US has come down a little quicker. New Zealand is still a little sticky, and again getting buffeted around by some of those near-term shocks. Clearly, energy markets again are a little bit all over the place, and that feeds through into inflation. But I think that's where that correlation has been. Probably you'd say many economies have been sort of correlated through this process. We've all faced the same global shocks. The policy recipe, I guess, has been pretty similar across a lot. I guess different economies have had different additional shocks overlaid. I mean, Europe's had the issues with Ukraine, Russia, and the energy crisis through Europe. The US less so. I guess our issues will be more related to China economic activity and our export growth up into the area. Just the fact that we're a smaller economy, we don't have that breadth of change going on. So, where I see it going, I think, I think probably US will still be the resilient economy going forward. It's just so large and so domestic, and we'll always be a little more volatile.
Okay. Major risks as the economist of the largest pot of assets in New Zealand. What are the one or two major risks you think haven't been priced in, or are still sort of hanging out there, which we need to deal with in New Zealand or more globally? And then similarly, are there any opportunities that you think for investors, again at the broader macro level, that aren't really in the front of mind in the way that they should be?
Yeah, well, when we think about risks, we think as I said before, we think more about what are those structural things that could come along to really change the environment. Now, clearly, through COVID, we've seen some of those, and quite a few asset owners around the world, long-term asset owners, have looked at the potential structural changes. Now, the one thing I'm always mindful that as an economist, you have your models, and every time your model doesn't give you the right answer, you think it's a structural change. And often it's not, it's just a different cycle or a different bit of volatility. But there have been some structural changes. I don't know about yourselves, but if I look even internally within the super fund, work from home is a massive structural change to the corporate world, or in any sort of world. And just in terms of what does that mean for CBDs, commercial real estate, as in terms of doing it pretty tough versus logistics, data warehousing, where the opportunities are. And so if I talk about opportunities and risks, where some of our real estate portfolio has pivoted, has gone really in looking at those logistic and data warehousing type spaces where there are significant opportunities, there's massive growth. And not just here, but we're looking at opportunities and investments across Europe, Asia, and the United States in that space. The geopolitical risk, it's a really tough one because it's really hard to price, really hard. I often, when I hear our geopolitical advisors come in, it's almost like a story time. They tell the stories about what's going on, and
They always make a great story.
oh, it's an incredible story. It's a bit like a soap opera, and then you go, okay, so what do we do about that? How do we adjust our investment, or how do we adjust our allocation to that?
And where does the story end?
And well, that's right. Where does the story end? And it's really hard. And clearly, the big one that affects investors and New Zealanders is what's going on in China at the moment, both from an economic and a geopolitical perspective. That's a tough knot to unravel, because clearly New Zealand has a strong reliance on exports up into China or tourists from China. China's going through an economic challenge at the moment, heavy property sector that's struggling, and that's sort of uncovered those well-known demographic and structural excess saving imbalances in China. And what does that mean for New Zealand investors? Now, we're part of that because, we not a strong part of the portfolio, or most of our portfolio is invested offshore, but we hedge the New Zealand dollar. So, and some of our direct investments are, like timber, some of our tourist holdings.
The end market is China.
Yeah, 100%. So while we actually have a very small direct holding of Chinese assets, but the world is affected. Apple is affected by China. So, and then the geopolitical stuff is an interesting one, because clearly you've got how do governments, particularly a government like ours, which has both the economic and the political relationships to manage, walk that narrow path. But also, just watching the from afar, the relationships between China and the US and how that goes on. And then the economic part of that geopolitical is the onshoring and friendshoring and deglobalization conversation, which we're sort of still only seeing parts of, and that will have an ongoing risk. Does that give me an opportunity? Does it identify opportunities? Not at this stage. Geopolitical advisors, they talk about risk and not much in the opportunity space, unfortunately. In terms of opportunities, now when we think about opportunities, we're always in that long-term space. So I'm not sure if that's helpful to your listeners, but I talked about offshore wind, I talked about alternative energy, I talked about the ESG space. That's where the opportunities rise. That is global tailwinds. And then I think the thing on the horizon, which I haven't done a lot of work in yet, but some are now, is AI. And again, is this just the next crypto? That's a bit of a not quite sure, or is it the next big evolution that's going to change the way we do things and change the way we think? And whether it be productivity, income, it's been talked about for a little while. Where's it going to go? And then I don't know.
We're just on that. We've had some specialists, AI specialists, come onto the call. They know about as much as you do. In terms of certainty in their forecasting, they know it's a big thing, but they can't, it's very hard to quantify what that'll mean in 5, 10, 15 years, and then it's very hard to quantify whether it's actually going to drive profits for companies, especially given the price you're paying for it today.
Yeah, that's right.
So, okay, hey, last question for me. Mark might have some others, but you talked about, I guess, the China miracle and huge economic growth, and then exporting inflation for a long time, which drove interest rates down. We have another miracle happening, which is India coming up. It's now more populous than China is. Is that going to counterbalance what's going on in China, or how do you see the relationship there?
The short answer is yes, but the long answer is long. And I guess what a lot of people are looking at is just the similarities between China 20, 30 years ago and India now, and it's largely around population size, demographics, labour costs, but there's quite significant differences in having the world's largest democracy and the world's largest single-state, single-party, communist-run economy. So it's not as simple as going, we'll just pivot. But saying that, I've been to, go to a fair few conferences in the last 10 years has all been about China. And now there has the pivot of, India. And you can't forget Southeast Asia. Because Southeast Asia is very nimble and maybe easier to get into and out of. We don't have, actually, I'm not sure we've got much in India at all at the moment. We've looked at it in the past. We've got some passive exposure to India. At the moment, it's not really on our list of things at the moment. We've got plenty of other things to be looking at. But I think globally, investors are looking for that next big global economic superpower momentum. Many investors that we've spoken to, are stepping back a little bit from China, particularly those ones who had strong active holdings in China. They're just a little nervous around the regulatory risk that's there. They're a little nervous around the economic risk that's there. And so by stepping back, they're then looking for what's next. I think India may well be the next one, but it's not going to be the same.
Tying those last two questions together, you have AI on one side and effectively emerging markets on the other, and you've had this, really almost for better part of 15, 20 years. Emerging markets, which were the darling, especially for share markets, have massively underperformed developed US markets. Have you got a view on those long-term trends?
Yeah, and look, we had emerging market strategies that we probably timed not quite right and have shut down. I think the first mistake we make is we bucket all emerging economies into something called EM, right? And we go, look at that, EM, they've got the same drivers and the same characteristics, and they haven't. So comparing a Brazil is completely different, even comparing to a Mexico or a China or a Southeast Asia or India or South Africa or Turkey or Egypt or, the typical emerging market classification. So that's the first thing, is that EM is challenging. And EM is challenging for a reason, because, there is different regulatory frameworks, there's different ways of doing things, there's even different ways of thinking about shareholder value and return. So that corporate principal agent concept, where the management's working for the shareholder or not,
Not necessarily.
It's different.
Yep.
It's different. And so when we think about, when we look at emerging markets, and we've recently done some investments into some smaller EM type economies, we look at a whole raft of things, not just, what is the risk and return, the investment risk and return, but also what's the regulatory framework, what's the ESG framework, what is it, what is the governance arrangements, what are the human rights arrangements, are different. So at the moment, we don't have any large EM strategies that we're contemplating, but we are looking at, some of our investment opportunities, such as in real estate or timber, where we do have, fingers out there.
And as it grows, it will be indirectly impacting assets more
But
broadly.
I guess return back to your comment that EM sort of hasn't quite kicked in like we would have thought, and I guess that's our thoughts evolving. One of the EM drivers was that this convergence idea that EMs didn't have to go through the pain of evolution of technology and productivity. They could just pick up whatever. But I think economies change much slower than that, and they have legacy drivers and legacy issues, and it really takes a leadership or a leader to wrench a country from its path.
And there's not that many emerging markets. I guess you've got your Japan and your Korea, South Korea and your Singapore, which have kind of achieved that at one level.
Yeah.
But in all cases, they've required huge reform and structural changes.
Great.
Okay, Mike. Thank you very much for your time. It's been an awesome session.